it's time for me to welcome to our cast of stars here on stage, the Chief Economic Advisor, Anantha Nageswaran. Mr. Nageswaran, if you could join us here on stage, please. Ladies and gentlemen, a big round of applause for the Chief Economic Advisor, Anantha Nageswaran. Mr. Nageswaran, many thanks for joining us. You know, before I talk to you about the domestic factors, let's talk about the changes that have happened overnight globally. And let me begin by asking you about what you make of the commentary that's come in from the Fed Chief Jerome Powell, stating that perhaps the first signs of a disinflationary environment. How comfortable does that make you feel, especially in light of the global uncertainties that we are faced with? Yeah.
So he, of course, did mention the fact that temporarily, at least for now, inflation pressures have eased. But he also mentioned that they are very determined to reach their 2% target, and they are committed to further rate increases. But the financial markets took a different view of his press conference. So that is what bothers me, because financial markets, having been conditioned over 2 to 3 decades in a different manner, or are refusing to believe that this Fed would want to see the inflation rate come down even further and would be poised to tighten. So the more they kind of engage in this eyeball-to-eyeball confrontation with the Fed and expects the Fed to blink first, and if the Fed doesn't, then the amount of rate hikes that will be required will become even more than what would be the case otherwise. That is what bothers me from the emerging market and the Indian angle.
And which is why you talked about entrenched inflation and the possibility of a longer tightening cycle as well in the economic survey. But that's one of the global factors. The other global factor that I want you to comment on, and I don't think that we've discussed that enough, especially since we've been poring over the budget, is the impact of what's happening in China. The reopening, bouncing back as far as manufacturing is concerned, the PMI in China coming back to about 50, under that is of course contraction. The implications of China reopening in the way that it has on the global economy, and what it eventually will mean for India as well.
So obviously, given the size of Chinese economy, whatever happens there will have a global impact, whether it's a slowdown or an expansion. And to the extent that if the recovery happens to be smoother, then definitely it would have it would impart an upward pressure on commodity prices. Including it will create a higher demand for crude oil. So therefore, we have to factor that into our calculations going forward in 23-24. So the speed with which Chinese economy returns to normal and the magnitude of the bounce from last year's growth rates will definitely have a material impact from the point of view of global inflation and from the point of view of commodity prices. So in fact, it could even prolong the monetary tightening cycle in the Western advanced economies. So that is something we need to watch.
Yes, we need to watch that. And so a slowing global growth is in fact advantage to India.
Slowing global growth would be what the doctor would order for India.
Would be what the doctor orders for India. If there are any questions here for the Chief Economic Advisor, do raise your hands and we'll try and get a microphone across to you. But please keep the questions relevant to the CEA. Yes, sir, go ahead.
Hi, my name is Anantha. There's one particular question that has been bothering me and I've never got a right answer for that. These FIIs that buy stocks in our country in the secondary market results in a lot of forex coming to our country. But none of the FIIs come with the intention of making less than 20-25% return on their investment. When this money comes in, the dollars come in, RBI absorbs these dollars, rupee gets into the market, inflation resulting in inflation. RBI absorbs this rupee by issuing bonds, borrows at about 6 or 7%, and then onward puts these foreign currency in US bonds, which earlier were yielding about 1 to 2%. So this whole benefit of getting FIIs to invest in our secondary market, I somehow have never understood. Has there been any data that how much money has come in by these FIIs in our markets, and what is the current value of that investment? So if let's say $1 billion came in and it is worth about $5 billion, whether the whole exercise was worth it?
So if you look at the data available from RBI and the national NSDL or CSDL, you do get data on the FII flows at cost. But if you want to know what is the value, current market value of these FII flows, then there is a separate table in the SEBI website, assets under custody, that would provide you the market value of the current FII holdings.
Well, you know, that I think is very helpful advice that's come in from the CAA on where to actually source information, where to look for information. But CAA, you know, on the issue of markets, and I want to address this with both you as well as the DIPAM Secretary, and it's been a fairly volatile last 24 to 48 hours as far as the markets are concerned. I want to link this back to you know, your point that you made about the indigestion having been worked out of the system. Bank balance sheets are looking strong at this point in time. Corporate balance sheets are looking strong, and which is why you believe that we are on the cusp of unleashing the animal spirits in the economy. But would you be concerned, and I don't want to draw you into any specifics, but would you be concerned about the kind of exposure that large conglomerates have to the banking sector at this point in time?
Based on the information we have, it doesn't look like at this point it has got the potential to derail the beginning of a new financial cycle.
Okay, so you don't believe that is the case at this point in time? Okay. Outside of you know, the global risk that we spoke of, which of course have to do with interest rates and inflation, and there are many imponderables there on how things will actually pan out given the geopolitical scenario at this point in time. What are the other factors that you're going to be watching for, both in terms of you know, what could move the global markets and then thereby impact India?
So, I mean, as I mentioned in the survey as well, almost 100% of the risks to our scenario for India's growth and inflation in the next financial year, almost all of it come from external factors. One is geopolitics, of course, how the ongoing conflict in Ukraine would pan out, both in terms of its duration and in terms of the intensity, and what kind of impact it could have on both crude oil price and also on supply chain disruptions. And second is the entire monetary policy tightening cycle and the strength or the weakness of the dollar. All these things would be key determinants of how our not only our growth and inflation play out, but also on how our external balances evolve in the course of 23-24. So as far as I can see, pretty much at this point, I do see predominantly external factors being able to shape or mar the kind of assumptions we have with respect to our real economy in the next financial year.
I'll come to, yes, we'll get a microphone across to you. If you can stand up, it's easier for them to spot you. Go ahead.
So I had one question. I run a large fintech platform headquartered out of New York. And one thing which is happening right now in US is the Inflation Reduction Act is actually a misnomer. It's for clean energy. You know, US is going to like massive amount of tax incentives coming in, so much so that even the EU is extremely worried. And what's starting to happen, we are seeing that, you know, that we fund a lot of businesses out there, and we are starting to see a lot of European companies even starting to shift their manufacturing over to US right now. And I don't see any like even debate in India around it, that how India is going to compete, you know, in that. And coming to the DIPAM Secretary, what Shireen had asked about the banking privatization. So what the government is doing with fintech platforms like us is that we are launching a lot of the tax credit financing programs right now for businesses who are setting up the units, because it takes time for them to get the tax credits back from the government, and the government wants it to happen and so that there's no fraud. The problem we have been interacting with Ministry of Finance also has been that because of lack of any legislative reform on the side of banking privatization, none of that can happen in India right now. So that clearly means that we won't be competitive both in manufacturing of clean energy, and we won't have the capital that is required, because the debt capital cost in India is so high today that if we have to compete in the world markets, then we need to have that debt capital also be available.
Sure.
And in US we get it from everywhere. Europeans are coming, you know, you name it, everybody is coming to finance that, right? Because that's a pretty safe kind of investment on the debt side, you know.
Sia, would you like to take that up?
No, I think I'm not really particularly, you know, convinced about, you know, because we have both private banks operating and the public sector banks operating in Indian space. So how is it that the privatization is linked to a particular business of fintech not being done?
GST was brought up here by the DIPAM secretary, and I want to understand what you believe the roadmap could potentially look like. You know, no one's now talking about rate convergence at all at this point in time, even though that was what the aspiration was, that we had too many rates and we should simplify the GST regime. More importantly, as far as the revenue neutral rate is concerned, your predecessor had put forward a revenue neutral rate. We're nowhere close to that at this point in time. What do you believe is the roadmap as far as GST is concerned? Should we just leave it where it is, because you know the government is happy with collections that are coming in at over 1.5 lakh crore rupees for now, so don't spoil the party?
No, the government is aware that there has to be a GST 2.0, but we have to understand that in the last 2-3 years we have had these one-off shocks, which obviously have distorted the speed with which the system becomes familiar with the GST regime. Therefore, we need to allow the system to settle down and become familiar and comfortable, which is what is happening right now, such that the average collection per month is slowly stepping up from 1 lakh crore to 1.4 to 1.5, etc. Whether there has to be only 1 or 2 or 3 rates can be debated ad nauseum. But when you have a country which is in a transition from lower middle income to middle income, etc., the path of GST settling down into a fewer rates than what we have will also take longer than it takes for us to debate this. And yes, the revenue neutral rate has come down, but at the same time, so far, if it leads to higher compliance and better transactions and better tax revenues for the government and greater efficiency, then probably we need to also update our estimate of what the revenue neutral rate is.
Okay. The second question that I had for you was to do with states. And we spoke about capex, central capex, which is at a 19-year high at this point in time, but the government is also incentivizing states to spend and supporting the states as well on that front. In your assessment, especially after the fact that the GST compensation window has closed as far as states are concerned, what is your own assessment of the fiscal health of states at this point in time, and hence their ability to also go forward with the reforms as well as capex spend?
So, based on the revised estimates for 22-23, we do see that states are absorbing about 80% of the interest-free loan that the union government provided for capex in 22-23. And we understand that as of now, the 22-23 state combined fiscal deficit would be probably around 2.4% of their GSDP, which is roughly 1% lower than what was expected. So on the face of it, I think states are doing their bit to consolidate, but we are also aware of the underlying issues of contingent liabilities, of power tariffs, viability of the power generation and discoms, etc. And now some of the states have indicated their intention to move back to the old pension plans, which will show up in their numbers 10 years down the road, etc. So there are underlying issues, but as of now, given the impact and the disturbance that COVID caused, states at the moment are on track to get back to a fiscal sustainability within the short-run parameter, while definitely I acknowledge that there are longer-term issues that need to be addressed.
अम्यूजमेंट पार्क तो बंद है।
The all-new Slavia.
राशि की स्कूल फीस, घर का किराया, कितनी जिम्मेदारियां हैं सर पे। तुम तो टर्म लाइफ इंश्योरेंस लिए बिना ही चले गए।
पॉलिसी बाजार पे 1 करोड़ का टर्म लाइफ इंश्योरेंस सिर्फ 430 रुपए महीने से शुरू।
It's the place where our worlds come together. She's the one and the moment lasts forever.
When you own every moment, the world will wait. Presenting Van Houston Destination Weddings.
फार्मा क्षेत्र में असंख्य संभावनाओं के साथ उत्तर प्रदेश प्रगति मार्ग पर आगे बढ़ रहा है और फार्मा उत्पाद निर्यात में 38.2% की वृद्धि के चलते विश्व भर के निवेशक उत्तर प्रदेश में रुचि ले रहे हैं।
फार्मास्यूटिकल, हेल्थ केयर रिलेटेड प्रोडक्ट का एक मैन्युफैक्चरिंग यूनिट बने, उसके लिए हमने अभी MOU साइन किया है। हम यूपी में ज़्यादा व्यापार उद्योग का विकास कर पाएंगे।
बदल रहा है प्रदेश और हर बदलाव के साथ उभरी है उत्तर प्रदेश की सुनहरी तस्वीर। ग्लोबल इन्वेस्टर समिट 2023।
अरे पिटिया का ना टॉपर, बेटा तुम हम पे तो बिल्कुल नहीं गए।
प्रणाम बहन जी।
हमें ये एहसास है कि कुछ लोग हमें क्या समझते हैं। इस कॉलेज का सबसे अहम अंग्रेजी शब्द टॉपर किसके पास? एक बात याद रखना, तुम्हारी पहचान सिर्फ तुम लिख सकते हो, बाकी सबके लिए तो पापा ने प्लान कर ही लिया है।
नए सवेरे नए हैं उजाले।
अपनों को इंश्योर करने के साथ उन्हें अपनी पहचान की ताकत का एहसास दिलाएं। HDFC लाइफ, सर उठा के जियो।
Let me also take the opportunity to welcome on stage the Economic Affairs Secretary Ajay Seth. Mr. Seth, could we have you join us on stage, please, as we take a question here from Rahul. A big round of applause, ladies and gentlemen, for the Economic Affairs Secretary. Go ahead, Rahul.
So I'm saying that what is the tax the economy of our size, economy of our kind should generate versus what's the tax that we actually collect? Is that reasonably converging, or is there a big gap or a small gap? How much is that gap, and what's the trend over the years on that gap?
Okay. If we can give an overall number, what we are collecting as an economy, I'm talking about center and the states put together, is roughly about 17 to 18% of GDP is our tax effort. Certainly, it is on a rural size. If you look at just about the BRICS countries, only China has of this order. All other three countries have a much higher. And of course, advanced economies have 25% plus. And China is a different, much more controlled economy, or rather is a controlled economy. So we have to move to the path wherein first from 17, 18% we reach to 20% before we think of where we move further. And in the last couple of years, if we discount what happened during the pandemic, inching up like last year, getting 11% plus centers alone, tax to GDP ratio is a positive sign. And more automation, GST and direct tax simplification is moving to that direction. So yes, approach is more ratio, more people into the tax net, a moderate tax rate, that's the general approach.
So given the, please go ahead.
I just wanted to add to what Secretary Economic Affairs said. If you account for the per capita income of India and compare to the kind of tax to GDP ratio that today's advanced economies had at a similar stage of development, then our tax to GDP ratio between center and the states put together of around 18% that he mentioned is quite comparable at a similar stage of development.
Is quite comparable at a similar stage of development. I think, sir, there was somebody else who had a question here. Yes, sir, we'll get the microphone back to you in just a second. Go ahead. It's there, right there. Yeah.
So my question is to DIPAM Secretary first. You did mention about the national monetization pipeline, some things have been done in InvITs and other thing. But if you read the notes, you would be falling way short of the target in this year. Now, there are some very easy baits in national monetization pipeline which can be done very easily. So is there any specific target now? You are adding back the target, what you're going to miss here, and do an extra this thing in next year? And my another question to Chief Economic Advisor is, we have been talking about that, oh, if the recession is there, it is good for India. My question is a vicious circle. Fed and Bank of England have increased the interest rates today. What happens is the capital flows into the fixed treasury bonds. That's the safest bet to do. Our exports, once the recession is there, goes down. The current account deficit increases. My dollar goes up. Rupee goes up against the dollar.
Yeah.
And it's a vicious circle. So the money flow into India will get hampered. So your growth targets of 6 to 6.8, which your economic survey mentioned, does it get impacted? Have you factored in these geopolitical and the recession in the West?
Let me get the DIPAM Secretary to start, and then I'll get the Chief Economic Advisor as well as the Economic Affairs Secretary to comment. Go ahead, sir.
Okay, and then National Monetization Plan, yes, I think you're right, there's some sectors which are doing relatively better than some of the other sectors. Because, if you see that if you're able to structure the things well, like for example in the road sector, it is fairly well structured, so therefore you can roll out faster. But in some of the sectors, like for example railways, this kind of models have not really worked yet. I think there were one or two, trials, but did not succeed. On the specific case of Ashoka Hotel, I can say the Ministry of Tourism is already working on it, and I think hopefully they should be able to work out a model and bid for it. So I think that's a part of their business plan.
Yeah, that's what I was going to say. Ashoka is actually moving forward. We don't know when it will finally happen, but perhaps the G20 year may not necessarily be the best time for the government to let go of it. But yes, Economic Advisor on the other question that the gentleman raised.
So, if the advanced economies actually slow down, you are right, first of all, about your comments about the impact on export growth, etc. That is why I mentioned in the survey as well, on balance, which means we take into account both the costs and benefits of slowdown versus continued growth in the developed economies. And on balance, I have concluded that in the current context of where India stands on inflation situation in the world, etc., a slowdown would be more beneficial than a continued expansion in the developed world, because it would have a meaningful impact on oil prices, commodity prices. It would bring them down. Slowdown on balance would be beneficial. But we have taken a range of 6 to 6.8 with a baseline of 6.5. And the fact that the baseline number is not centered between 6 and 6.8 does convey a story to you, which is that in the current global context, we do see that downside risks are more than the upside possibilities to the baseline number.
Put a very specific question to you, because this has been long pending, India's inclusion in the global bond indices. Is there any further movement on that? Because we were given to understand that it was only a matter of time, and in the early part of 2023 we would finally move towards that, and the issues related to tax, etc., had been addressed and sorted out. Is there any clarity on that?
See, at this point of time, coming to the requirement of for the government borrowings, including that of the state government at the current level of projections, our domestic savings can well take care of that.
Okay. Let me then address the issue that has been raised by many overnight on the rural budget side, and there has been a decrease, there has been a decline there, and one could understand that on account of the lower allocation as far as NREGS is concerned. But if you could explain the thinking and the rationale behind what we've seen happen specifically as far as the rural budget is concerned, and why the decline?
It will not be a correct statement to say the rural budget has come down. Of one particular scheme is the NREGS, that allocation has come down, but that scheme is demand driven. People come for a wage employment because they don't have any other employment opportunity. And as we are seeing it, the economy is picking up, especially the services sector. There is a pull factor from urban areas, people migrating back to the urban areas, and they are getting the job opportunities there. But an equally important, what the fiscal is trying to do, for rural housing, budget has gone up from 20,000 crore to close to 55,000 crore, 54,400 and plus crores. So increase of 170%. Who are the people who are going to construct? Machines are not going to construct. Those houses will be constructed by human beings. So there will be a job demand will be coming in. Similar manner for drinking water, rural drinking water, budget has gone up from 60,000 to 70,000. Of course, part of it will be material, but a significant part will as well be material, because that all has to be embedded below the earth. So these two significant increases which generates job or wage employment in the rural area more than compensate for what has been the reduction in terms of NREGS, but that is based on assessment that demand for wage employment will be less in the coming year. And if it were to be contrary, then obviously through revised estimates, suitable provisions will be made.
The budget has very clearly said that it may not be reliable due to the unprecedented global turbulence and headwinds to put the 24-25 and 25-26 targets as part of the FRBM, and that is what you have stated. So just wanted to understand, because you seem very confident, and yesterday the Finance Secretary also said that we shouldn't have a problem of being able to consolidate 0.7% annually over the next 2 years to get to that number of 4.5%. Why then haven't we placed the glide path in the budget?
It's a question that when we are trying to project beyond a year and over a period of 3-year time, then we have to be sure that assumptions which are making have a reasonable chance of holding on. What we have to look for in terms of the correction, about 2 percentage point over a period of 3 years, whether these are divided in 3 equal sizes or they are different. Now we have taken one slice, 0.5%, and that 0.5% is decided based on our assessment that next 1 year public investment has to play a very strong role along with the private sector investment coming in to keep the growth momentum on. That's why a 0.5, not a 0.7. Now next 2 years, whether the second year can take a more than half of that 0.7 or more or less, depend upon how we see the situation evolving and the global headwind subsiding by that time. That's why a firm commitment, once an act is amended, laid down, becomes a difficult one. But we are very clear that come 2025-26, we have to reach below 4.5%.
Let me ask the three of you about the growth magnets, and I'll start by asking you, since that was something that the economic survey mentioned very specifically. You know, of the areas of the priorities that the government is working on, has identified, what do you feel the most confident of in being able to really turn the needle as far as accelerating growth is concerned?
I think the first growth magnet for us will be improved balance sheets, improved the private sector capex cycle will commence, and increasingly third will be the public digital infrastructure contribution to growth, because it is going to address 2 problems that India has been facing historically. One is informality and financial exclusion. Both are being addressed. So all these 3 things are going to be important growth contributors.
Mr. Seth?
Some of the signs which are seeking, not in just in terms of the consumption, but we also see in terms of the taxation data which is coming in, even especially in terms of the GST data, and also the gross fixed capital formation, which have been the highest in the first half of the year since 2014-15. These are the signs that economic activity is reviving very strong, and I see that momentum going forward. And when we are talking about growth accelerating, when the adverse external environment is adverse to us, the first goal is to stay closer to 7%, which we are trying to achieve this year, and before, when the global headwinds subside, then think of beyond going 7+.
Okay, yes, and that is the aspiration that hopefully we will be able to do 7% plus. Gentlemen, it's been an absolute pleasure. Many thanks. I know that you have another engagement to get to, so I don't want to hold you back, but thank you very much to the DIPAM Secretary, to the Chief Economic Advisor, as well as to the Economic Affairs Secretary for joining us here on the CNBC-TV18 Budget Verdict. We appreciate your time, and thank you very much for joining us here with your insights.